If you are tired of risking big money and only making small profits, then it is time for you to learn high risk-reward trading. In this video, I will explain step by step how I take trades with very big profit potential and small risk. Now let us start with today's lesson. Why high risk-reward trading is important. Before I show you the full method, I want to explain why high risk-reward trades are very powerful. Here's the simple reason. When you target big rewards on your trades, you do not need to win all the time to stay profitable. Let me explain with a few examples. If you always take 1:1 risk-reward to make $100, you need to win at least 6 out of 10 trades just to stay profitable. That is very hard. Even professional traders win only 4 or 5 trades out of 10. Now let's say you go for 1:2, risk-reward $100 to make $200. In that case, you only need to win around 34% of the time to stay profitable. That's better, but still a bit risky. Now let us go higher. If you trade 1:5, you risk $100 to make $500, then just 2 wins out of 10 trades can still make you profitable. You can lose 8 times, and those 2 winning trades will cover everything. And if you aim for 1:10 risk reward, you only need 1 win out of 10. Yes, just 1 trade, and you are in profit. Yes, just 1. That's why we focus on reward, not just on being right every time, because the truth is, most retail traders only win between 20% and 50% of their trades. So if you want to win in trading, you need to make more when you are right, not try to be right all the time. The problem is, most traders try to win every trade, instead of focusing on how much they earn when they win. Why timing matters. Most traders jump in too early, or they chase the market and lose their advantage. Let me show you exactly how I find perfect entries. Step 1. First, check the direction of the market. In this trade, price pulled back and then broke market structure to the downside. This gave us a clear swing high and swing low, confirming that the market is now moving down. So now our plan is to sell from supply zones closer to the top. I marked a strong supply zone near the top, a zone that also grabbed liquidity from the previous high. This is what we call an institutional zone, a high probability area where smart money enters. Then, on the 15-minute time frame, I spotted another smaller supply zone at the top. The earlier supply zone had already been tapped. Orders were likely filled, so I ignored it. Now my focus is only on the fresh, untouched supply zone. Step 2. Look for inducement. When price drops, it doesn't just fall straight, it creates small pullbacks along the way. Each small high becomes a liquidity pool, money sitting above. So I look for inducement candles forming near my supply zone. Once that happens, I identify the liquidation candle, the one that grabbed the liquidity above, and only then I take the entry. Here's exactly how I take my entry. First, find the liquidation candle, the one that grabbed liquidity. Second, place a sell stop just below that candle, exactly below the low. Third, if the next candle is bullish, shift your stop loss just below that bullish candle's low. Fourth, if the next candle forms an inside bar, do nothing, just wait. Fifth, keep repeating this process until your trade gets triggered. Once price activates the trade, my stop loss is placed just above that candle, and I set my target at the nearest demand zone. This trade gave around 1:3 to 1:3.5 risk reward. To manage risk and lock in profit, I used a trailing stop. That way, even if price reversed, I was protected. Now let me show you a bullish setup. The first sign, price broke above the previous structure, confirming bullish strength. Then I identified a strong demand zone near the bottom, and this wasn't just any zone. It grabbed liquidity from previous lows, making it even more powerful. I focused on the inducement closest to the demand zone, the one most likely to be used in a liquidity grab. Then I saw a candle actually close below that inducement. That was my cue. Liquidity was being taken, the liquidation candle, showing smart money entering the market after the grab. I placed a buy stop above that candle, stop loss below. For take profit, I targeted the nearest internal lower high, a logical point where price could react. This trade gave me a clean 1:7 risk reward. So that is how I take entries for high risk reward trades. There are many small details I didn't cover here, but if you're serious about becoming a better trader in 2025, like and subscribe. Thank you for watching.